in like 30 seconds.
Okay.
We got it. All right, we're live. Peggy, how are you?
Hey, Nick. Good. How are you?
Oh, just another day of Bank of Canada announcements, right? It always makes for an interesting day. Really
Do you know
funny.
what I love about these days?
Tell me.
You never call me ahead of time to tell me what the heck we're going to talk about. I love it. I love it.
Well, we know what we're here to talk about. We know what we're here to talk about. And the really funny thing is that the last Bank of Canada announcement, I said in our presentation that we did, I said, you know, it's been a very busy day at the office, and it's going to be even busier as the day goes on. You called me at the end of the day and said, was it as busy as you thought it was going to be? And my answer was, no, it wasn't.
No.
Why? Why, Peggy?
Because this is old news for us. We don't care anymore.
Right. Well, it's definitely old news for sure. And that's why when these things happen, our phone actually rings less, like way less than we thought it was going to anyway. So, the first announcement, yes, it was, it was crazy. It was a storm of phone calls, clients looking for advice, consultations, mortgage reviews, and that sort of thing. The second one, the third one, like it kept on happening and happening and happening. But these more recent increases have brought fewer questions, I'll say, because it's anticipated. The media is doing a really great job of just telling everyone, hey, listen, these increases are expected. They're actually even more than expected. They're almost guaranteed. It's just a matter of how much. So,
and I think a lot of people may have been banking on 75 for today and they didn't get it.
Yeah.
Which
so,
I think is a positive if you ask me, because I think we're getting towards the end.
So we did a poll yesterday and asked consumers, do you think it'll be 50 basis points, so 0.5%, or 75 basis points, 0.75%? And the overwhelming feedback was that everybody thought that we were going to see 0.75, so 75 basis points. What we in fact saw was a 0.5% increase. It's a 0.5% increase. So that's going to bring prime rate to 5.95%.
It actually makes me very hopeful that they only went 0.5 point, because it makes me think that maybe perhaps they'll quiet down a little and watch the data, right? Because that's what we all want. We all want them to relax, watch the data, and guide by the data, not by, the seat of their pants.
Yeah, now there's another announcement coming in December. What do you think? Do you think we'll see another one?
I think we'll see another one, but it'd probably be a 0.25 maybe. I don't, because I think what's happened, I think there's been an overreaction in a lot of sectors of this economy, not even necessarily housing, because I think housing, considering everything they've thrown at us, we've held up really well.
Yeah, so I concur. I think December you'll see a 0.25% increase. So one of the things that I put together here for us, Peggy, was this. It's the prime rate increases that we've seen, like just basically this year, and a few stats as well. So let's go over them. So starting in the left-hand corner, the Bank of Canada meets 8 times every year. Now, the most recent increase before today, this is before today, was 0.75, bringing it to 5.45%. But here's the really interesting one. Like if you go up to the top right here, prime started at just 2.45% in January. And that was the lowest level since 2009.
Right.
So prime rate before today had increased by 3% in 2022 alone. It started at 2.45, went to 5.45 before today. The increase alone was higher than where it started.
Right.
Now, after today's increase, it's increased by 3.5%. So it started at 2.45. It's increased by more than it started, which means that it's more than doubled, obviously, right?
Absolutely. And really, you would have expected more fallout than what we're seeing. I have seen quite a bit of fallout, and not even the housing market. The housing market has held its own. And the reason the housing market's held its own is because I think people feel like, you know what, you've done this to us before. I know where this is going. We know there's not enough housing in this country, so we're going to hold out. I don't believe that sellers are frantic. They're just not listing their homes.
And is that what you're seeing? Like, we're still seeing a lack of supply when it comes to homes.
And less supply now than we've seen since all this started in March, April.
So
now.
So it was very limited supply, right? In the really hot housing market. Like, you couldn't find a townhome, for example. We'll use townhouses as the example, right?
Right.
So no townhomes, like very limited supply. As soon as interest rates started to increase, home prices started to decrease. And then I remember in one of our more recent chats, you were saying, okay, well, there's, take your pick, 30, 40, 50 townhouses on the market. That has that it sounds like that's slowed down now. There's not as many listed now.
It has slowed down. Some of the inventory's been absorbed, but you don't see people rushing to the exits. You just don't see it. And I think they were expecting more of that than what we're seeing. But I still believe that people are working.
Yep.
So whatever the rate is, they're paying it, because even with variable, because most people's variable payments have maybe doubled. Am I guessing?
Well, I'm going to go through that in a moment. Actually, you know what? Let's go through this slide right here. Now, this is before today, okay? Because when the Bank of Canada makes a decision to increase rates, prime rate typically follows with it, right? So prime rate will go up, but before today, we're going to use this example. So, before 11 o'clock today, when this was announced, these were true numbers. Okay. Yep. So the last increase was 0.75%. So we're going to use that as our best example, because those are the questions that we've been getting for the last, month. For example, an increase of 0.75% will cost a borrower an extra $750 a year.
Right.
Okay. But that's for every $100,000 borrowed.
Right.
Okay. So hold your breath on that one, because I'm going to show you something really interesting. The total increase before today's announcement was 3%, which means that will cost a borrower $3,000 for every $100,000 borrowed. But Peggy, who has a $100,000 mortgage?
No one.
No one. So if a borrower had a $500,000 mortgage from January to yesterday, right before today's announcement, because it's only going to get worse after today's announcement, then their cost of borrowing has increased by $15,000 this year. Broken down per month, that's $1,250 a month.
That's a lot.
It's a lot. Now, really, what are we looking at here? We're looking at borrowers who had really low interest rates for about 2 years, right? These folks typically, when prime was at 2.45%, had prime minus 1%.
Yep.
Right. So at prime minus 1%, they would have had an interest rate of like 1.45% for a couple of years. And now it's going up and up and up. Okay. So one of the other questions, just to answer your question in long form, I guess, is that we get is, what's the cost? Like, what does it really cost when interest rates increase? So let's check this slide out. Okay.
Okay.
So interest rates were, fixed interest rates were about 2% in January, and variable rates were lower than that. They were 1.45%. So if someone had a $500,000 mortgage at 2%, 25-year amortization, so like a first-time home buyer, for example, their monthly payment would have been $2,100. And at maturity, after 5 years, if they just paid monthly payments, no additional payments, they'd owe $418,000. Now, when interest rates went up by a full percent to 3%, that payment moved up by, as you see here on the second line, about $250 a month.
Right.
But here's the other thing. At maturity, they would owe about 10 grand more. So there's not only the monthly payment difference, there's it costs more because the interest rate is higher as well, right? It's not just the monthly payment. So when an interest rate moves up by 1% on a $500,000 mortgage, do you know how much it costs a borrower over 5 years, Peggy?
What?
Right there.
Wow.
$23,000.
That's scary.
It is. But check this out. interest rates were here. Okay. Like prime was 2.45% in January. After today's announcement, it's 5.95. Okay. So within 1 year, we've moved from the top of this table to the bottom of this table.
And considering all that, the housing market has held up freaking fine.
Okay. So let's yeah. So tell me about home prices. Okay. Like the people online today have heard us talk about the fact that, you know, you may have paid $1 million for a home in January and got a 2% interest rate. The same home could have been purchased in August for $850,000, but the interest rate would have been 5%. And the person who bought at the lower price with the higher interest rate would win after 5 years. We have lots of videos online about that. If anybody wants to see them, just let me know. I can share them with you. But, you know, if you bought at a lower price with a higher interest rate, you'll win after 5 years. We have all the math on that. So we know that home prices went down. How do home prices look right now, Peggy?
We're down about 30%, 28 in some areas, 25 in others. It ranges between 20 and 30%. So the froth is gone. And I mean, we're not seeing month over. So we started losing 5% a month since the rate started going up. So every month we came down 5%. Yeah. September, maybe we came down a couple of percent. And now October has been pretty great. Like
good.
Things have been moving. Days on market are coming down. So I think when the numbers come out in October, you know, they're either going to be flat or they may even be up a little, not much, 1%. But our days on market are coming down, which is really promising. So there are buyers out there. They're willing to buy. You just have to price your home at the right price to get it gone. If you price your home at the right price in Barrie right now, you can be sold in a week.
I was just going to ask that, not to put you on the spot, because we don't need the actual stat. Generally in Barrie, days on market, you think right now, what would days on market be in Barrie right now? So that's for those that are viewing. Yeah.
We were as much as 45. I would say we're probably down to 20. And so, again, a lot of that is skewed by overpriced homes.
So it could be less.
Exactly. That's why I'm telling you, if you priced your home properly right now in the city of Barrie, like your home is sold.
Yeah. So for the viewers, days on market is from when you list your home to when it's sold on average. Correct. And, you know, to Peggy's point, if your home is, if a home is overpriced, it may sit on the market for longer than the average, and that'll drag that average up, right, Peggy? Like that could drag it up to 45 days, for example, if they're overpriced. So
our numbers.
So when days on market was at, say, 45 days, do you think it was that high because of consumer confidence, like people just weren't buying? Or do you think that was because people were still thinking that their house was worth more than it actually was for the market?
I think it was a combination of the two. I think a lot of people, it took sellers a while to realize that we are in different times. I mean, nobody wants to believe that, and I don't blame them. I don't want to believe it either. I own a home. However, they have now realized that that is no longer the case. This is a new time. This is a new day, and we have to carry on. And honestly, like the prices have not dropped as much as they should have, considering the battering that we've taken in this interest rate environment. Like, and again, it comes down to supply and demand. Like everything else always comes down to supply and demand in housing, and we just don't have the supply. And the fact that people are working, they'll figure out how to pay that mortgage. They're not rushing they're not rushing to put their homes on the market and taking a loss. They're just not doing it.
Yeah. If you look at this as a macro perspective as well, like that's the micro that you just mentioned. But I listened to one of your favorite economists a few weeks ago, Benjamin Tal, in a speech that he was making in Vancouver. And he said, paraphrasing, of course, that about 1/3 of GTA developers have either sold or scrapped their plans to build their next development because of market uncertainty and, most importantly, increasing interest rates. Yeah, these folks are borrowing $70, $80, $90 million in development financing in a market where values are also decreasing and consumer confidence is decreasing. And there's a government who's actively trying to cool the housing market. So, you know, their profits are already diminishing. And now all of a sudden, you know, there's somebody who's coming in and affecting their supply and being very vocal about, or pardon me, their demand and being very vocal about it. So they're just going to sit on their hands. They won't, you know, they won't build their next project, or they'll sell the development land at a profit instead. And what that's going to create ultimately is even more of a supply issue, right? Because developers aren't creating new units. We call those housing starts, right? So if there's decreased housing starts and already a problem with supply and demand, meaning it's high, right? Then like, where are these people going to buy homes, right? And it's not going to ultimately solve the problem.
No, it is not solve the problem.
So can I ask you, this is not a you know, a stat question. This is a Peggy Hill opinion question. You know, I own a townhouse in Barrie, and let's just say it's a nice end unit townhouse on a good street. Like, I'll just pick one out of the air on Chervino, for example. So that end unit townhome is probably worth $650,000 right now.
Bang on.
And that house in January would have been $800,000 or more.
Minimum, maybe 850.
Right. So let's just say it was 850 in the high, because there was some crazy things going on. And let's say it's 650 today. Where is that house value going over the next, say, I'm going to say 3 months, like right into January sort of thing?
So that's our dilemma right now. A lot of our clients are either expiring and everybody wants to wait till the unicorns come in January or in the spring market, because that's when it'll be the land of unicorns and fairy tales. And it just isn't going to happen. Like, we don't see prices going up at this point because affordability is not there. So unless we can get more buyers into this system, we're not going to be able to raise these prices. And the buyers are only coming in if they can afford it. And if the rates come down, and I don't think the rates are coming down. So as long as the rates don't come down, we are vulnerable pricing wise. We are.
Yeah. So I'm going to show you another slide here. Because I just want to, you know, sort of show everybody this is the one I'm looking for here, the monthly payments. So $500,000 at 6%. Now, 5-year fixed rates are still floating right in around here, 5%. Yeah. So at $500,000, the monthly payment is $2,900. And I know how you feel about this, because in past videos you've said, like, you know, if you buy a townhouse, or if you buy let's just say you come up to Aurelia and, you know, you buy a $525,000 home and you put your 5% down, or your minimum down payment, you'll have a monthly payment of just under $3,000 a month plus your property tax. And you said before, it's too much because you can rent the home for less. And that's never been the case before in history. Nope. So what we're finding with clients calling into our office looking for a mortgage is clients are buying homes in two circumstances. Number one, they have some sort of like motive, like, I mean, like a real motive. So if they're going through a divorce, for example, and they need to buy a home for themselves and their children in a specific school district to get grounded in a new home and get their family settled, 5% interest rates do not stop those folks.
No.
And if someone has been relocated to a new town, 5% interest rates don't stop those folks. And if someone, let's just say, is the opposite of the first example. So, you know, I get remarried and there's a blended family and we need a bigger home. You know, that's number one. And number two is, I think, what you guys are seeing as well, which is that people are making concessions on what they're looking for. So they're going, you know, from a townhouse in Barrie, and they're saying, I'll drive 40 minutes from Midland. I'll get a lower price home. It'll be fully detached and it'll be on a big lot.
Right.
So when people ask us, well, who's borrowing this money? Like, who's paying these rates? And what does that look like? Those are the two audiences. So tell us what you're seeing in your office, Peggy.
So we're seeing, obviously there's always life events that we have to deal with. We haven't yet, it's what we're not seeing that makes me actually delighted, is we're not seeing people calling and saying, I can't afford my mortgage, I have to sell. So, and I think that's what the big worry was with all of us, was that when these rates went up the way they did, that people would be having to sell their homes. And because they're working, they're not. So, I mean, that makes me hopeful for the economy, and it makes me hopeful for the whole picture all around. So that's the part we're not seeing. We are seeing life events. We're seeing people. I mean, I've seen people sell their homes to free up a little bit of equity to pay off their cottage, you know? So I think there will come a time, because these HELOCs are a problem as well, right? Because I was an investor like everybody else. I used my HELOC to put a down payment on in a second property. So those are not attractive anymore. No.
Yeah, I totally agree. So, you know, what we're seeing as well is, like, if someone has payment challenges, and I've said this, you know, on past videos as well, if anybody's listening to this, if you're having challenges paying your mortgage because of increasing interest rates, reach out to me. There's free advice. I'm happy to answer any of those questions. I don't want to hear that anybody is having challenges making their payments, because that's an awful situation. What we see in most cases is people will call our office and look to simplify their life. I hate using the word consolidate. Simplify their life. They want to right size their family's finances. And what we do is, you know, we take a look at consolidating car loans, credit cards, or any other payments in their life. And really what we're just doing is right sizing their finances and saying, you know, if you don't have money for this, you're going to be spending from debt. So let's right size the payment. Let's get something that's affordable for you. And sometimes those conversations lead into, maybe I need to downsize my home, but I'm not having those conversations with clients right now, and I hope not to. And to your point, I don't think you're having those conversations yet either.
No, but I do want to encourage people that are listening. If you're finding yourself in a spot, please reach out either to Nick or myself. Call us. Like, we are so happy to sit down and have a conversation. And sometimes when you're not in the issue, when you're looking at it from outside of it, we can come up with solutions for you. But I don't want to see people losing their homes. I don't want to see people forced into selling. There's ways of getting around everything. Everything is a solution, but you just need calm heads, and you need to sit down and discuss it, because the last thing either one of us want is for people to panic. And you're not seeing it. And that makes me so happy. It truly makes me so happy. Would I love more listings? 1,000,000%, but not at the cost of people losing their homes and having to displace their families. So
and I think I've mentioned to you as well, these are actually very fulfilling times for us as a mortgage company, because we get to sit down with clients, give very high level advice, you know, get deep into conversations with folks that really appreciate the time and knowledge and advice that we have to give. When interest rates were 1.59% fixed, Peggy, as you can imagine, like, our industry became very commoditized. You know, like, oh yeah, that's low, I'll take that. And we're like, well, we should talk about it. What's there to talk about? There's free money, you know? And the payment was affordable. But now is time to start strategizing and saying, okay, you know, even if you have the 1.59% 5-year fixed interest rate, there's probably 3 years remaining on your term. And you know what's going to happen at the end of 3 years? Your payment's going to go up, and we need to start planning for that. So if you know, as you say, anybody is watching this today is in a panic about their payments, please reach out to Peggy or I. We'll connect you with our team and talk to you about what the increases really cost you as a borrower, right? Because there are options. There really are. Like, it's not, you know, you may not have to resort to just selling your home, for example. I would say the conversation is, you know, 1 with Nick, 2 with Peggy, and say, is there an option to reduce my payments? Yes, no. Is there an option to right size my finances? Yes, no. And is there an option to right size my house? Yes, no. Because there could also be a conversation with, someone who says, I've been meaning to downsize my home for 8 years, and this now might be the right time to do it because of increasing interest rates, for example.
Yeah.
And, people often forget as well, like, they sell at a lower price. Like, let's say the prices that, we know have gone down in some cases 30%, but they'll buy at those lower prices as well. Right, Peggy? So if you're looking, like, the only time you're really gonna, I'll say, lose, for lack of a better term, on decreased prices is simply if you're leaving the market, right? If you're leaving the market and not rebuying.
Well, and the only thing I want to leave with people right now is because I hear a lot of people saying this is such a bad market. This is not a bad market. If you need to sell your home, you can sell your home. There are bad markets where you're not guaranteed that. This is not those markets. So I am hopeful that we've held our own. Yes, we've gone down 30%. Yes, we'll probably go down a little bit further, but hell, it could have been a lot worse with the increases in interest rates that we saw any other time. Things would have been a heck of a lot different. Yeah,
I totally agree. And I love thinking back to like February as well, Peggy, when prices were high and you were telling people, like, you were screaming it from the rooftops, sell your house, don't buy. Just give us the listing, give someone else listing, don't care, sell your home. And go park your money somewhere, like go rent in Friday Harbor, go move out to the East Coast, go do the things that you always wanted to do, because today you won the lottery. And if, using that same example, if you had an N-unit townhome on Trevino, sell that townhome for $850, better yet, list it for $850 and,
go into multiples,
yeah, absolutely. Peggy, we just had a question in the chat. Maybe you can just answer it really quick. Can you just clarify? It's 30% down from the peak, or 30% year over year? It's just from the peak, right?
Peak. We are actually right now we are working. I'm going to say late spring 2021 prices.
Late spring 2021 prices. Yeah. Okay. So, I had this conversation. A little earlier with a client. So they said, my house is probably worth $650,000. I said, okay. And they were deflated to say that to me, right? House in Innisfil, little old cottage in Innisfil. Very nice, like very nice. And he said, yeah, 650. And I said, whoa, wait, Dave, what are you talking about? He said, well, it was probably 750 in February. And I said, okay, what was it in 2019?
Yeah.
Early 2020.
We are not in anywhere near 2019 prices. We aren't. And that was my fear, was that's where we were heading, and heading there quickly, because if the rates were going the way they were going. But again, the only thing that saved us and keeps saving us is we don't have the supply.
I always learn so much from you on that perspective, because it's just not something that we work in every day. Like, we talk rates, and rates are moving so fast. I joke with you that sometimes I feel like a stock trader. I have like 4 screens open, and the green bank increases interest rates, and I'm like, oh, they're up, but red bank is still down. Oh, red bank is up now, and who else do I have? Oh, blue bank's up now again. So every day it's changing and shifting like multiple times in a day. And it's very difficult to keep track of, but I have a good grasp of that. And sometimes, and we have a good grasp of prices and what's happening in the housing market, but sometimes I forget those drivers like supply and demand, for example. And hearing you talk about days on market and listing activity, and the amount of, the other stat that you remind me of all the time, which is months of inventory as well. So
months of inventory matter, and supply and demand is the only thing that matters in real estate. And our issue prior months is that the buyers were just frozen in time. So we had no supply, but we had no demand either. However, that's turning around. I can see the demand is still there. Supply isn't. So it's our saving grace.
Yeah. And months of inventory, Peggy, can you just give us just a quick overview on that buyer's market, seller's market, and just generally where we are right now? We won't
Sure.
hold you to the actual statistic.
No, I'll tell you the actual statistic because I live
I
and
know
breathe
you
it
do.
every single
I know
day.
you do. Yeah.
So right now we're at about 2 months supply in Barrie. Simcoe County as a whole, we're probably about 3 months supply. Some areas are more, like we've got Springwater over $1,500,000 or $1.5 million.
Yeah, dollars. Yeah.
We've got 6-7 months of supply.
Yeah.
That is a buyer's market. So there's
Yeah.
not a lot moving in Springwater in the higher price ranges. But every dog has its day, right? Like that'll come in time. However, Barrie right now, 2 months of inventory, which is nothing, which is all day long a seller's market. We need at least 3 months to call it a balanced market.
Yeah.
So we don't have that. We don't have that. What the issue is, we came from a market that was 0.2 of a month, 0.4 of a
days,
month. Yeah.
Days, you know, like I remember saying to you, months of inventory, and you said, we're going to start calling it days of inventory, Nick.
Yeah. That's all
Right.
that's what we were dealing with. And you know, it's not like that right now. We do have a couple of months of inventory, which is not a lot, you guys. It really isn't a lot. And it is the saving grace of this market is the fact that we don't have supply. And that's why I encourage people, if you don't need to sell, this isn't the market to test. The test will fail because we're not seeing crazy increases. But if you need to sell, you can sell, which is like amazing, because even with the stock market, the number one thing with the stock is liquidity. People love stocks that are liquid, you can get in and out of them quickly. So the same with this housing market. If you need to get out of this housing market, you can. So there's no need to panic, but you know, there's other alternatives out there as well.
Yeah. And for those who are watching, like, you know, months of inventory suggests that if not another house was listed after today, every single house on the market that's currently listed would sell in a 2-month period. Flush out the entire listing database. Essentially, that's what months of inventory represents.
Correct.
Yeah, gotcha. So for those watching, as a brief overview, the Bank of Canada will be increasing prime rate to 5.95%, its highest level since 2009. That is generally affecting those with variable interest rates, home equity lines of credit, and adjustable interest rates. Now, if you have a fixed rate mortgage, your payment and interest rate should be unaffected by this announcement. But we want you to keep your eye on things. And for that reason, if you have a fixed interest rate, my suggestion to you is to take a look at how much time is remaining on the term of your mortgage, let's say 2 years. And if you're paying a 2% interest rate and we expect interest rates to be 5% in 2 years, we want you to start increasing your payments manually and gradually for the next 2 years to prepare yourself for higher interest rates. If you have a variable rate mortgage, an adjustable rate mortgage, or a home equity line of credit, you will likely be affected by today's change. And if you have questions, you can reach out to my team at Mortgage Wellness, Peggy's team at the Peggy Hill Team. We'd be happy to offer free advice to anybody with any questions anytime.
Amazing.
Peggy, thanks as always for your time. Really appreciate all those insights. That was really, really great. And again, if anybody has questions, reach out. It's peggyhill.com. It's mortgagewellness.ca. And I hope everybody has a great day.
Thank you.
Bye, everyone.